Hello everyone, I'm Nova Lui, the head of investor advisory at RHB Bank. Welcome to our podcast, specifically targeting a discussion on recent China's equity market performance and its prospects in the medium to long term. From 31st December 2024 to 31st August 2025, China has clearly outpaced the US equity market. China, in fact, has outperformed the US indices close to 3 times more on the year-to-date basis. This strong rally in the China and Hong Kong market are unseen for the past 4 years. Today, we have Mr. Jee Toon, Chief Investment Officer and CEO of RHB Asset Management Singapore. Jee Toon, thank you for joining us today. It's timely and very relevant at this moment of time. Jee Toon, the PBoC implemented rate cuts and reduces the reserve requirement ratio in May, however left the interest rate unchanged in August. Is this combination of liquidity support without aggressive rate cut sufficient to drive a re-rating of Chinese equity market? Which sectors are likely to benefit first from this monetary policy approach?
In my opinion, I do think that these measures are definitely enough to drive a re-rating of the stock market. I think PBoC is clearly signaling an easing bias, but obviously they are also trying to calibrate very carefully all the different toolkit that they have at their disposal. In my opinion, I do think that the large cap Hong Kong listed China shares will be in the best position to benefit from these moves. Because on top of this liquidity driven rally, we do have very, very strong structural stories like, for example, AI as well as capital market flows driving all these large cap stocks that are listed on the Hong Kong exchanges.
Jee Toon, there's one sector that we also need some guidance from you, which is on the property sector. The Shanghai recently eased home buying restrictions, allowing eligible residents unlimited home purchases in the outer suburbs. The city also eliminated the first and second home mortgage rate distinction and raised housing provident fund loan cap to 2.16 million renminbi, targeting suburban inventory clearance. Property shares responded positively. Should investors reconsider property-related equity opportunities?
In my opinion, I do think that these policy tailwinds are real. In fact, we have seen policy loosening for the last 12 months or so. I do think that we have come to a situation whereby prices should start to stabilize over the course of the next few quarters. However, in terms of investments into the property stocks, I do urge investors to be very, very careful because, in my opinion, many developers are still under financial stress. So it's very important for us to do our stock picking right at this juncture. For our portfolio, we have started to invest into the property market for the first time in many, many years from late last year. I do think that stock picking is most important at this point in time, and we are clearly seeing bottoming out of the property sector.
Another sector that may need to tap into expertise is on the tech sector. By looking at the portfolio that you manage, relatively, we will easily see exposure into lack of the tech underlines. So recently, Beijing has unveiled an AI plus action plan on August 26 to accelerate AI adoption and has proposed establishing a new global AI cooperation body. Could you provide some insight into this initiative and highlight investable opportunities that investors may consider for their portfolio?
In late August 2025, the State Council released guidelines called AI Plus. AI Plus is to accelerate integration of AI across many sectors, including science and technology, industry, consumption, and welfare into the daily lives as well as the economies of the future. It's important for us to get involved into stocks that are able to achieve what we call the last mile. Essentially, those stocks or companies that are able to integrate AI into the daily lives of the Chinese population will stand to benefit immensely. In our opinion, that is one of the main reasons why we have a large exposure into a lot of these Chinese internet and technology giants. They are in the best position to take advantage of these policies that will be implemented because of this AI plus drive.
The next question is on the southbound flow. Jee Toon, mainland investor has poured record funds into Hong Kong this year, with Hong Kong exchange first half profit surging approximately 40% on increased stock connect turnover. Are southbound flows now providing structural support for the overall offshore Chinese equity market?
Nova, you are quite right. Mainland investors via Southbound Stock Connect have been pouring immense amount of money into Hong Kong equities. Current inflows are at record levels right now. In my opinion, southbound flows will definitely be a key drivers of these Hong Kong and China stocks that are listed in Hong Kong. Roughly speaking, about a quarter of the flows on a daily basis can be attributed to the southbound flows. In my opinion, the stocks that will benefit will be these large cap stocks that are listed in Hong Kong, which would include the Chinese internet stocks, the Chinese financial stocks, as well as the Chinese technology companies. They are in the best position to benefit from these flows, as these are large cap stocks, and also these are also structurally exposed to the theme of AI, technology upgrades, as well as self-sufficiency from the perspective of the Chinese economy.
Thank you very much, Jee Toon. This is my last question. On the offshore Chinese equity market has done so well this year. Is it still a good time to go in, or would it be too late for investor to go in for this type of equity market? Investor is thinking that is this turning point of the potential multi-year upside prospect in the Chinese equity market sustainable?
In my opinion, I think this multi-year upside potential is definitely there. There is a very clear direction of policy support in terms of liquidity, in terms of industrial as well as sectoral support. The fact is, I think AI will be a key feature of the economy as well as the stock market come. And I do think that the Chinese stock market have great potential as well as exposure to this AI theme. In addition, I think the valuations of a lot of these Chinese stocks are very, very cheap compared to their global peers. As what we spoken earlier, the southbound flows as well as domestic institutional interest from the Chinese fund managers will continue to push these stocks even higher.
Thank you, Jee Toon. In order to give our audience a broader view on the Chinese equity market prospect, we have another speaker with us today, Mr. Raymond Jing, Portfolio Manager at China AMC, joining us all the way from China. Welcome, Raymond. Good to see you again.
Thank you, Nova. Nice to meet you.
Raymond, Washington and Beijing has extended their tariff truce by 90 days on August 12, 2025, temporarily averting steep tariff increase. However, export growth has slowed to a 6-month low in August as tariff uncertainties persist. Given this stop-go pattern in trade negotiation, how should China equity investors position their portfolio to navigate the ongoing tariff volatility?
Yeah, we think the ongoing tariff volatility will continue. One example is the most recent rumor that US mentioned, possible extra tariffs if China buy Russian oil. I think China equity investors should avoid holding too many export-related names, especially those exporting to US directly. At the meantime, the ongoing tariff volatility will bring a lot of opportunities. For instance, export pressure will lead further fiscal support from government and loose monetary policies. And in October, as we know that China will introduce next 5-year plan, we believe the government will emphasize the importance of tech and innovation-related industries, that will surely instruct clearly on what areas we need to allocate. Nova.
Thank you. And Raymond, in terms of the tariff, we also noticed that Mexico has recently announced plan to raise automobile tariff on China and other Asian countries to 50% as part of the broader import levy overhaul aimed at the protecting domestic job. Additionally, early September reports indicate that White House also urged Europe to impose tariff of up to 100% on the Chinese and India export to pressure Russian over oil revenues. What are your thoughts on the implication for China's economy overall as the US lobbies other nations to impose tariff on China goods?
Yes, these news indicate potential pressure on China's export. We cannot get the positive conclusions on China's economy overall, so we can anticipate China government will enhance fiscal support to stabilize domestic demand. And that's why we prefer structural opportunities rather than overall sectors in China equity market. For example, the auto sector, we don't have too much allocations, but besides potential tariffs, auto sector also face the high base situation and potential tax cut normalization in next year. But we do have some names in our portfolio as the supply chain leaders also play very important roles in humanoid robotics industry. We think, for example, the robotic industry will be a more promising industry and need our focus. So that is, some suggestions on our conducting in managing products.
Still on the global platform, China has recently had meeting with Russia and North Korea during early September event in Beijing, emphasized a closer coordination. However, analysts notes that there is a limited uh, details and absence of a formal trilateral summit. How should investors incorporate tail risks of potential sanctions and export control into China equity valuations?
Very good question. It seems that domestic investors played more important roles in China equity market till now since last September. Among domestic investors, the most powerful strength comes from China financial national team led by Chinese government and SOEs. And we see that global funds flows keep quite mixed. We didn't see significant long fund inflows back to China equity market, but some data shows that as China bull market continues, more and more global funds get interested in China and may come back sooner or later. So we don't see any negative fund flow potential. Even if potential sanctions and export controls you mentioned may lead some short-term turbulence in China market, we see such volatilities as great entry points in a very early stage of bullish market in China now.
I have a pressing question on the sectoral exposure in one of your portfolio, which is on the healthcare sector. We noticed that your portfolio maintains a significant healthcare exposure. So happen coinciding with Warren Buffett's recent vocal support for the healthcare investment. Could you share your investment case for this sector and explain how healthcare holdings add value to your overall portfolio strategy?
Healthcare sector in China is a growth sector in our framework, especially biotech our preference subsectors, and we have already seen some unique names within that. And the rationale is very clear. The first, that within total medicine market in China, innovative drugs market share rise fast or rapidly in most recent years. Revenues generated by innovative drug companies exceed the total market and the China's economy as a whole. So the second one is China biotech influence rise globally. We can see a lot of global MNC, we say multinational companies, they're willing to license in China biotech pipelines. So from volume to amount, we saw clear upward trend. The third, our strategy is good to growth sectors in China. We all know that. So overweighing biotech sectors meet our investment strategies and can provide decent alpha to our portfolio performance as a whole.
Thank you, Raymond. And this is my last question. When looking at the China A share, it's clearly that it has a lag behind the Hong Kong listed Chinese equity market. Despite that, the China A share market has also done better than the US equity market. So what are the catalysts that you could see that drive the onshore market to catch up with the offshore market by end of the year?
Yeah, the catch-up of the onshore stock have already happened in some specific sectors, such as starboard and China export in Asia. That represent the growth sectors, and there's listed companies such as the AI-related, humanoid robotics and biotech. So we think it is easy to do sector allocation in a bull market this time. We will keep overweighting tech, high manufacturing, and biotech. China onshore market will mostly benefit from migrating of excess, deposit from China citizens. And we're pretty sure such kind of migration have already started, and the potential amount of can reach as high as tens of trillions. So it should be a mid to long-term bullish market for China equity market, not only the offshore but also onshore. And the catalyst, the catch up of onshore such, I think could be the 15th five-year plan announcement in next month in October in short term. And innovation should be the main driver in China for next 5 years. So it means growth sectors may outperform in bull market for next few years. So that will all lead to some structural opportunities in onshore stock markets to catch up the offshore market by the year end.
Yeah, investor, when it comes to unit trust investing, we are not just looking at the broad market performance. In terms of the fund managers, bottom-up stock selection and also sectoral exposure would also increase potential excess return to your investment portfolio. Thank you again, Raymond, for joining us, and appreciate you for sharing with us despite a short notice. Thank you.
Thank you, Nova. Thank you for having us here.
Dear investors, a successful investing requires a long-term perspective with dynamic portfolio management. In response to current market conditions, we are strategically allocating exposure of our model portfolio to capitalize on attractive valuation and growth prospects in the Asian and China-Hong Kong markets. We have identified several funds on our platform that align with this investment thesis for your consideration. We encourage you to schedule a consultation with your designated relationship manager to discuss how these opportunities may complement your existing portfolio allocation and support your long-term financial objective. Thank you for your continued engagement with our investment insight. We look forward to connecting with you again in our upcoming podcast series.